From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, July 26th. Welcome to the Macrocast. Tony Fratto here from Hamilton Place Strategies. John Fagan and Brendan Walsh with Markets Policy Partners. John is here in the studio as well. Brendan is off in more comfortable climes, but joining us remotely. Hello, Brendan.
From Cape Cod.
Yeah,
you guys.
Good for you.
Well, the GDP number was all consumption, so I'm doing my best to help
continue to drive consumption. Yeah, let's get into that in a second. We had we're going to talk about a lot of things this week: earnings and equities, and looking ahead to the Fed, and we're going to look at ECB and Brexit and Japan as well. Hopefully, get into all of those things. But first things first, where is the global economy? This week, we saw really disappointing numbers out of Germany, and really not great on the global growth front. IMF was out. Some from IMF talking again, and then we just got just a half an hour ago or so, a little earlier this morning, we got U.S. GDP. Consumer was very strong, but top line number not. Would say it didn't exceed expectations. No.
Well, expectations were about 1.8%.
I'm sorry, yeah. They did exceed expectations, but on the backs of a very, very strong consumer.
That's right. Yeah, and a lot of the what they call the whisper number on Wall Street, a lot of the analysts had kind of revised down lower. You had the closely followed Atlanta Fed and New York Fed GDP tracker numbers that were down at 1.4 and
really
3% coming into it, and there was a sense that the risks were to the downside, but that's not what we got.
Brendan, it was that beat on GDP was largely dependent on the consumer, right?
Yeah, so we had positive contributions from personal consumption expenditures, and surprisingly, federal government spending and also state and local were quite strong. But it was private inventory investments and exports and non-residential fixed investment and residential fixed investment were quite weak. But part of that, I think, you kind of have to average the two of them together because, especially on the business side, probably a lot of businesses front ran the tariffs. So the first quarter was probably higher than it should have been, and second quarter is a little bit lower. But the kind of big story from today was the consumption was running over 4%. So the U.S. consumer seems to be doing quite well.
We also saw some revisions in for 2017, 2018 too, right? I mean that I guess like the sort of cycle ended up about where it was expected, but some of the composition changed a little bit.
Yeah, and I also think we had the tax cut and you get a little stimulus from that, but the reality is we're in a 2% GDP world, and it doesn't seem to be a huge amount to sway it one way or the other.
How do you guys think this is going to inform, the Fed? We have the Fed next week. We have three major central bank decisions next week, right? We have decision. I don't know. ECB seemed to punt until September. Draghi maybe putting things off, but we have the Fed and
Bank of
Japan.
England. Yep.
And Bank of England. That's right. Yeah.
Yeah. This is, and the market is reflecting this. This number might have been a relatively meaningful upside surprise, particularly in the consumption side, but and relative to the lower and more depressed whisper numbers and estimates that had been in other places on the street. But it really didn't move the needle on Fed expectations very much. We're seeing a slight decline in the market implied odds of a more aggressive 50 basis point rate cut next week on the 31st, but that's only very marginal, and those had been down below 20% coming into this figure anyway. And in terms of what we saw, the dollar isn't really going anywhere this morning. Treasury yields are pretty flat, and a lot of that is owing to the fact that the Fed has made it pretty clear that in their recent communications that they're focused on inflation and overseas weakness, and perhaps domestically business investment, and that's those are still pretty weak.
Yeah.
And the reality is, if you have a number like this that's an upside surprise that the Fed is unlikely to react to, it's not going to move the markets that much. And when we think back to the June non-farm payroll number that was so surprisingly strong, part of the reason that moved the market so much was because the Fed really hadn't laid the groundwork they hadn't made it exactly clear the extent to which they were data dependent and what data they were dependent on. And then subsequently, Fed Chair Powell came out and made it quite clear what they were looking at. And,
it's been clear ever since, I think. Right?
That's right. And so this is a good number. It doesn't change the 100% odds that are implied by the futures markets for at least a 25 basis point rate cut next week.
What about the yield curve? Do you see any insight to be gleaned from the recent movements there?
So we have seen a lot of steepening, and there is a sense that the Fed has been purposefully focused on the yield curve and trying to uninvert parts of the yield curve just for everybody that's not necessarily following every development of the yield curve. Traditionally, yield curve inversion, when front end yields are higher than longer dated yields, that is a signal of an impending recession with a lag up to maybe even a year, a certain number of quarters. And this has been, we've seen certainly yield curves coming very flat. The most commonly watched is the difference between the 2-year and the 10-year. Now that's actually never really inverted. It's gotten pancake flat, but it's never gone negative. And a lot of commentators, you can sort of pick and choose your section of the yield curve that you like the best. The 3-month 10-year has been inverted. So if you're a bearishly minded,
that started back in May.
And basically the rule of thumb on the 10-year. On the inversion of something, a portion of the yield curve, to make it meaningful, it has to be at least a quarter, and I believe that the 3-month 10-year has been inverted for more than 1 quarter.
Yeah, I think that's right.
It started back in May, but it just recently went slightly positive, I guess.
Right. So if you're going to be taking the signal from at least the 3-month 10-year has already flashed, and nothing that the Fed can do right now as they try to elevate to steepen up the yield curve. Nothing they can do can negate that. But there's plenty of argument, and we've covered this in previous podcasts, as to why the yield curve might be a little distorted. The 10-year is getting pulled down by the gravitational pull of exceptionally low interest rates in Europe and Japan particularly.
Yeah. And that's not going to change anytime soon, right? I mean, that dynamic, and if we're looking at, I want to get into ECB and some of the other banks, but they are all, fully within, we're in a global easing cycle. I think it's fair to say the Bank of England for other reasons as well, anticipating a potentially hard Brexit.
That's right. Yeah, the global easing cycle is the only question right now is the degree to which they're going to be going into this new accommodation cycle. How far are they going to need to go? And that is obviously going to be dependent on how global growth forms up in the second half of this year. I think certainly for the Fed, when you're looking at the continued U.S. economic outperformance, just looking at the GDP numbers on its face, it certainly doesn't scream out emergency rate cut,
right?
Emergency rate cut needed. And so their argument has been a little nuanced. Now they can, there's no way they're escaping from their 25 basis point.
I don't think so. I don't see how they could possibly
at least, right?
That. Yeah.
But in subsequent months, this can change. They'll probably cut 25 basis points, maybe 50, but probably 25 basis points, and signal that more is to come. If they cut again in September and growth doesn't look materially worse in the U.S., the question is, are they really going to be, after doing 50 basis points over 2 months, is this the kind of time they're going to be signaling maybe we'll go on pause?
And that's your base case is they're going to do 50 points either in one hit or two hits.
That's right. My base case is they do it over 2 meetings. They cut in 25 basis points July, September. And that's, that sets up, and we talked a little bit about this last week, that sets up potentially a bit of a divergence in policy, because the ECB, as we saw this week, signaled, we're going to be sitting on our hands, but we're going to be getting rolling in September.
Yeah. Well, it seems a bit weird, don't you think? I mean, Draghi, who I actually think has been a pretty good communicator I think he's been a very good communicator. I think he's very good at making clear what his intentions are. I don't understand the strong signaling of something 2 months away. Because if you could see it now, why not just get there?
I think that's exactly what the market was querying after his performance. It was a relatively restrained performance in relative to expectations.
Yeah.
That he is a go big or go home kind of central banker, a real showman, and so this was his opportunity to steal the limelight from the Fed and get, not just maybe a rate cut going,
since he actually is going home pretty soon.
He is going to be going home. I was trying to think of like what the analogy was. He's like neither going big nor going home. It's like he stopped off at the cafe along the way, to have a coffee before choosing which direction to go.
Well, it
was quite surprising. This is what they want to do. Everyone's on board, so why just do it? You
guys have made this point before, and we talked about it. It's like it's hard for forecasters, right? So central banks, anticipating a slow. They're very bad at predicting recessions, right? And it's like, well, of course they're bad at predicting recessions because their job is to combat recessions, or right. if they predict a downturn, it's a dynamic environment there, and they do something about it or should do something about it.
Also, could you imagine a central bank saying, things are great for the next 2 years, but 2021,
look out,
pandemonium.
Yeah.
Right. Yeah, they have to assume optimal monetary policy, or at least something close to it, that they're not fouling
that
it
it's
up.
going to succeed. Like that the policy choices that they're putting in place, that they have to assume they're going to succeed. Otherwise, why would they do them?
That's right. Some of the commentary seemed a little unfair after Draghi's performance yesterday. The expectations were such that he was obviously emphasizing downside risks, signaling that more easing was to come. But the market did, clearly wanted more. They wanted him to be wearing a hair shirt and fire free euro out of a cannon
right.
and predict a great euro region depression coming up. It was the mindset, though, is, I think, it's understandable in the context of pretty dire looking EU, particularly German economic data. We were supposed to get some stabilization in the manufacturing gauges this week. We did not get that. We got a relapse to the downside. June's modest hints of stabilization, even if many of those gauges were still in contractionary territory. That did not continue in July. And we saw some think tank, also the IFO Institute, which is a influential German think tank. The president of IFO said the German manufacturing is in free fall.
Wow.
That's a really strong statement. And so the fact that he held off and restrained, I bet traders will probably immediately begin to think, well, he only did that so he can really knock the ball out of the park in September.
How much? This is a concern, certainly a concern in Japan on what their policy options are. Qualitative or quantitative easing on their end. But none of the banks have a lot of room. And we talk about here in the United States that there isn't a whole lot of room to lower rates. We have some. They don't have tons of room to do sort of traditional, right?
I think that's right. That the sense is that the ECB has more rate cuts in them potentially than the Bank of Japan. The Bank of Japan was surprising that they went negative, given the statements, particularly that Governor Kuroda himself had made about the deleterious effects on bank balance sheets of negative interest rates. And the Japanese banks are, certainly very dependent on.
They can't make any money.
Yeah, and so when he surprised the markets, I believe that was 2017, when he surprised the markets by going negative with interest rates. It was quite a shock, and banks stocks in Japan fell precipitously. So there's a sense that maybe the odds are that maybe they can. It's more of a signaling thing if they go 10 basis points. But the market implied odds for that are not high over the next few meetings. The expectation is that they will probably have to resort to extending their guidance, which is a little flimsy, saying we're going to keep
yeah.
pushing our extraordinary easing off into the future.
I mean, they've done creative things like asset, ETF purchases, right, and other things.
That's right. And right now, there's obviously the yield curve control, which they've transitioned from quantitative easing, which is buying a set amount of Japanese government bonds, to basically pinning the 10-year Japanese government bond yield at zero,
right,
within a band. And they have said that they will buy as much or as little as they need to maintain that band. Well, year to date, they haven't had to buy that much. There just hasn't been a lot of pressure on the upside. There was a sense when, during 2018, when interest rates were rising and global growth was supposed to be on an upswing and things were getting a little bit exciting, that the BOJ might have put themselves in a pretty bad position, that they would have to, that the market might begin to test them, that they would sort of fall short. They widened the band a little bit and played around with some of that, but the pressure has really come off.
Yeah.
And they're not buying as much as they, as their sort of target would indicate.
And then
where is that buying demand coming from?
I think part of it is obviously there's a lot of homegrown, there's a lot of homegrown demand in Japanese government bonds. There's also
huge. I mean, it's unusual compared to almost any other economy, right?
We've also seen this trade kind of come in.
That's where my question comes from. Is this something that other central banks can take as an example of could work for them, or is that something unique to the Japanese culture?
This Japanese monetary culture is certainly very unique. They've gone. The Bank of Japan has arrived at monetary settings that are much more extreme than their peers, and certainly in terms of the volume of the central bank balance sheet. I think it's. Don't quote me on this, but I think it's the size of their GDP at this point. It's a really huge number. And they've been doing it for a very long time. They are buying a lot of ETFs. There's some hand-wringing about the fact that when you look at a lot of Japanese companies and look at the top shareholder, that top shareholder is Bank of Japan.
Bank of Japan, yeah.
And it creates a not such a capitalist feeling. And when you have 10-year rates pegged basically right at zero,
yeah.
Is that a market? I guess so. But,
I guess so.
It's still it's a very different kind of arrangement. Now, the caveat would be 10 years ago, what Japan was doing looked weird to a lot of central bankers in the world, and now, lo and behold, they are at those same kind of settings themselves. So.
It is, and I don't know. It's hard to see where the way out of this, really super low environment is. I mean, we're heading back into another, and I'm not troubled by just the range or the fact that rates are probably forever going to be relatively low. But it is weird living your life in these ranges. It's really bizarre.
There was certainly a sense in
and that speaks to the anger of the guy in the Oval Office about the strength of the dollar. But when the 10-year Greek bond is below the U.S., it's kind of hard to see why the dollar is going to weaken, because the U.S. still has the highest rates in the world.
10-year Greek yields. It's a massive,
Greece has been around a whole lot longer than the United States. It's been there for it's very durable country.
That's right. I mean, looking back at in the late Bernanke years, and certainly through the Janet Yellen timeframe at the Fed, there was a sense of urgency, of a yearning to normalize policy. Let's get back to where we used to be, to normalize, and that talk has dissolved.
The new normal. The catchphrase is way overused, but the way we think about what is a normal, normal rates. I think is we have to rethink that a lot. I mean, we're not. I don't think we're never going to see 4s and 5s or 6s again.
Yeah, I mean the sort of scary formulation when you think about it is, either all of this incredible, ultra accommodative monetary policy isn't working, isn't working very well given the economic outcomes that's kind of scary to think about. It's even scarier to think that it's really working well, and but for this, things would be
really disastrous.
Far worse. It's I would hesitate to say which one of those formulations is true, but
okay. Why don't we let's take a break? We're still in the midst of earnings season. When we come back, I'm going to talk about earnings. You're listening to the Macrocast.
You're listening to the HPS Macrocast. Every Friday, we take a look at the major economic trends of the week. See more from Hamilton Place Strategies at hamiltonplacestrategies.com or on Twitter at HPS Insight.
Okay, welcome back to the Macrocast. Tony Fratto here from Hamilton Place Strategies. John Fagan, Brendan Walsh with Markets Policy Partners. Still lots of earnings this week. A few more to come. What do we see this week that tells us something?
Overall, it was a more upbeat week. Last week was the first big week of second quarter corporate earnings reporting in the U.S., and it kicked off with the banks. The banks are in a low rate environment. When rates are coming lower, it's hard to be bullish on financials. They weren't a big drag. It wasn't huge misses, but it's not the kind of excitement that is ginned up by the kind of earnings that we get this week, like the big tech firms. Lots more excitement around and buzz around those names, obviously. So the first week we had, we had CSX, which was the rail giant, saying pretty downbeat stuff about the economy. This week we got another counterpoint. We got UPS, which is another transport, the shipping, the circulatory system of the economy, saying very upbeat things about its domestic business. Internationally, obviously, there was a reference to the drag from trade, but certainly investors expected that, and the strength of the domestic business in UPS really carried that stock higher. That was a real shot in the arm. We got positive, and the headliner this week was Google knocking it out of the park with advertising revenues bouncing back. Google had been the underperformer among the so-called FANG stocks: Facebook, Amazon, Netflix, Google. Throw Apple in there with an extra A sometimes. And Google had been lagging, and this was a very positive earnings. I think the stock is up 11% this morning, and that is, that's overbalancing some of the negativity that we've gotten from Amazon. Was a rare miss.
Yeah.
And that wasn't, it was more the bottom line. They had some cost overruns. The stock isn't down that much. And that's kind of the tale of this week. The upside surprises were really took off, and people were quite excited about Starbucks. Great numbers from Starbucks. Intel, which has had a really tough year, and they impressed analysts. Texas Instruments was another one, and those stocks, the stocks that beat to the upside and impressed analysts, really got a big lift. And the disappointments were just not that disappointing. They tended to be something that would, there was just like Amazon, which is a little bit of a bigger spend. Also, Facebook they had great numbers, but they couldn't really overcome some of the regulatory scrutiny. A lot more talk about the antitrust investigation into what they are doing. So also Boeing and Caterpillar, which in past earnings seasons, when they've had a very disappointing quarter, that's shaken the confidence.
We kind of had, obviously all the coverage to Boeing, we kind of knew Boeing was going to have a tough quarter. And Caterpillar, I think there was because of their global business.
Right. They talked about the costs from tariffs, and people were expecting it to be bad. And
so they weren't great, but there were no surprises there.
Well, we didn't have any downside shocks, and the downside moves weren't all that big. And so this week of earnings season painted a much more positive and upbeat picture, even though we still had some high-profile, sort of nuanced and patchy results among some of the headliners.
And Tony, I'd be very interested in your take. So I've been fascinated by how the market reacted to the antitrust headlines, where, if you read it right away, the government's getting involved, they're going to break these guys up, that's bad. But actually, Wall Street's kind of been saying for years something like Google should break up because they own YouTube, and YouTube they estimate is 30 to 50% undervalued within Google, and if you spun it out, it'd be worth a bunch more. So the first reaction was kind of sell, and then the second reaction was kind of like, hey, wait a second, we're on board with this. We've been saying this for a while.
There are different reasons. That's a different. If you're going to try to unlock value there, that maybe people can't see, with Google's Google, YouTube, you could see that the threat was the threat is about antitrust, which is kind of the opposite argument, right? If the market is saying, look, you're not realizing enough value, you could be, you can create more, you can unlock more value by breaking up. The critics and maybe what the government might be looking for should be that you are extracting monopolistic value by the combination of these things. Those are actually two opposite arguments. So it's really
completely opposite.
Yeah, they're diametrically opposite arguments, and I think that is just when people and policymakers are just people too, they look at these things and they have a hard time understanding what they are. I thought one of the interesting numbers, we talk about Google's rebound in advertising, but some of the numbers that came out on Amazon I thought were just fascinating, and just the of Amazon's surge in advertising revenue, which is just another reminder that all of these big technology platform companies that the Elizabeth Warrens of the world and maybe the Trump administration DOJ think are monopolies, they're actually competing tooth and nail with each other, right? I mean, fighting over dividing up the advertising market they're fighting really hard every day to try to capture that market, and it's not. We used to think about Google, and Google has a big share. Amazon is there, Facebook is there. Others are trying to take pieces of that. On entertainment, they're all talking about YouTube. YouTube is competing with Netflix. They're competing with Amazon Prime. They're competing with the broadcasters and Hulu. There is a lot of really, a big, strenuous competition going out there for each of these companies. And some of the critics, I think of them in some old-fashioned way that, Amazon is a marketplace, Google is search, Facebook is a social platform, Netflix does movies, and that's all that they do. And they're getting all into each other's businesses. They're all becoming marketplaces. They're all becoming content providers. They're all becoming search. They're all becoming advertising platforms. So people need to open their eyes a little bit and take a bigger and more sophisticated understanding of what these businesses are.
I think that's a really good point, and I think that is you can imagine the lawyers from these big companies beginning to marshal these arguments. Antitrust is a very complex area, and analysts point out that it's really hard to make antitrust cases stick. You have to prove. I'm going to demonstrate my ignorance, but basically, it's a pretty challenging set of proof to go through. There aren't a lot of high-profile antitrust cases in the U.S. In the U.S. And it's not straightforward. I think we'll all over the ensuing months learn a little bit more about how these processes and how these cases might play out, and what the different sides will be, the arguments they'll be marshaling. But I think from the analyst perspective, model that, right? Stick that in your model and smoke it. It's impossible. How can you? Nobody knows the likelihood of these cases, the timeline for these obviously extremely complex. It would be years. Yeah. Is it, what kind of penalties might they suffer? How? It's a really, really difficult thing to model. And so when you see, I think you generally, like with a lot of policy stuff, you see the announcement effect, where that one day, or there's like a half-life of an hour where you get some downside in the stocks, and then everyone says, I'll worry about that one.
Right.
And you get it playing through very quickly. And so there's announcement/event and then process, a long, boring process, and the markets just can't keep their eye on that ball.
Yeah, I think it's too far. It's too far out for them also. And it's also, look, I mean, if you were to think about, uncoupling YouTube from Google, that seems clean and easy. If you want to uncouple, I don't know, WhatsApp from Facebook, maybe that's clean and easy. But so many of the pieces of these companies are integrated, and they're really hard to figure out how you would want to, breaking up Facebook. What does that mean? Breaking up Facebook, like regional Facebooks, what is it? Right? What exactly does it mean in a what may be by its nature a winner take all kind of business? At least for the core element of creating a social platform, right? There just may not be. You may not be able. That may not be a market that lends itself to that kind of competition.
Yeah, but it's also kind of fascinating, especially with the Facebook scenario, where we're talking about breaking it up because it's a monopoly. But before we broke up monopolies because they were price gouging. Facebook's free. They might be taking a lot of going a little too far with what they're doing with our data, but that's a different story than price gouging.
Yeah, and as we talk about the difference between the United States and Europe on these issues, I mean, those are two regulatory environments that have different views on what monopolistic activity is, and where here we are take a very complex subject and making it very simple, but we're broadly more interested in the consumer, right? Prices and services available to the consumer. Are they getting, greater prices, greater choice, better services, more choices at lower prices? If those things are happening, it's hard to say that it's that a company is acting, monopolistically, right? That it's using its market position to harm the consumer. In Europe, they look at the composition of the producers in the market. The firms need to be able to have sufficient scale in the marketplace to effectively compete with each other, and they don't focus so much on choice. They presume that if you have those conditions in from among the producers, that the consumer is receiving better services, more choices at lower prices, and it's just not always the case.
Yeah, that's really interesting insight.
Yeah, John, anything else we're seeing out of earnings that you think is interesting?
Well, broadly, the headline numbers continue to be strong, and companies are beating earnings and sales estimates at a very high clip. But some analysts are pointing out that guidance is pretty muted, and expectations for the second half of the year in terms of earnings aren't going up in the way that some had expected. And this isn't really impacting stocks that much right now. We've still got a lot of macro tailwinds, the Fed easing, some positive headlines from the U.S.-China trade. They're going to be face-to-face meetings next week. That always seems to cheer the market up.
Still a party.
Yeah, and there was another sentimental positive this week, which kind of boosted everyone's spirits. The debt ceiling, the can get kicked. Well, it appears to be ready to get a big boot 2 years down the road until after the election. That's obviously something that's marginal, but there were a lot of there were some positive atmospherics that kind of boosted up what we've got and maybe covered up some of the guidance down the road, which was pretty tepid. People think the second half of the year might be a lot brighter if the U.S. and China can sign off on something that's meaningful over the next couple of weeks, and then everybody's got to change their outlook.
Even just back from the brink a little bit from them to just be sitting down and talking. I think has created a lot of relief in the markets. All right, why don't we take a break right there. When we get back, take a look at next week. You're listening to the Macrocast.
The first Friday of every month is Jobs Day, when the latest jobs and labor market data are released. HPS makes sense of the numbers in our Jobs Day report. Sign up online at hamiltonplaystrategies.com or follow us on Twitter to learn more.
Welcome back to the Macrocast. Brendan, it's a big week next week between banks and data. What are you paying attention to?
Yeah, you're gonna have to pay attention to a lot. So in China, we get a couple important manufacturing PMIs, both the official one and the market-based one. We get Eurozone GDP for the second quarter, and then we also get the Fed's PCE inflation number for June. So they'll have that when they meet on Wednesday for their decision. The BOE is going to meet on Thursday. The BOJ is earlier in the week. And most importantly, we get the jobs data on Friday. So the market's looking for about 160,000. I'm not sure. I don't think that the Fed will have that number when they meet. Do you know how that works? If they're able to get it done, I don't think the BLS it completes it until Thursday, so I'm not sure that they'll have that in their decision-making toolkit.
I'd only heard of it coming out the night before, and certain people
that's
are in possession of it the night before.
That's my experience. It does not go over to the Fed until that evening before. It goes to the Treasury Secretary, Fed Chairman, and the director of the National Economic Council. At least it did. I don't know if they still do that.
Right, but as we saw with U.S. GDP, second quarter GDP, it would, no matter what it is, it would be hard to knock the Fed off their line.
Right.
I mean, you could create 1 million jobs, and they'd probably still have to cut.
1 million jobs.
1 million jobs.
Yeah, I have a hard time seeing anything throwing them off. I mean, was there anything, John, that you saw in guidance from anyone reporting this week that gave any indication as to how they're seeing the output outlook?
It was all, it's a mixed bag, to be honest. And we certainly saw the CSX with a pretty dire outlook, and then we saw trucker J.B. Hunt and UPS that are shipping and transport, and they had a much brighter outlook.
Yeah, I thought that dynamic was fascinating. You're like, oh, it's the end of the world, and then 10 minutes later, the competitor reports and says, yeah, actually, things are kind of all right.
Yeah, very patchy, and the sense that there is a big delta potentially on the back of what U.S.-China trade resolves or doesn't resolve over the next few months.
Yeah. All right. So, what are your guesses? We're going to get. Where are you on jobs? Where are you on the big Fed decisions?
I've already held forth about my 25
and 25.
Yeah, I'm at 25, and then try to pause and get some blowback from the markets. But Brendan, what do you think about the jobs number?
Kind of the best predictor of the jobs number is the claims numbers, which have been amazingly low. And there's a little bit of a noise because car makers shut down in the summer. But, if 160 is consensus, I would take the over, maybe 180, 185. And then I think after the New York Fed backed away from Williams' comments, that you kind of have to assume a 25 and not 50 anymore.
What just came across Bloomberg, White House rules out any currency intervention. Kudlow. So we haven't been 100% in our predictions, but I think we all predicted.
Why intervene when you're cutting? That's the Fed's going to take care of it for them. Much more powerful than whatever Treasury can muster anyway.
It's interesting that they felt the need to come out and say it.
Yeah. Well, he was being interviewed on CNBC, so I'm sure the question might have been put to him.
Sure. I mean, they played coy before. I thought that they would leave it on the table.
That's true.
And I didn't think they would do it, but I thought that they would, hint that maybe down the road. And we, as we discussed, if the Fed tries to stop their cutting cycle in September, just when the ECB is getting rolling, the Bank of England might be starting to front-run a hard Brexit. The Bank of Japan might be starting to front-run their consumption tax hike, which is scheduled for October.
Right.
That might be the time frame when a lot of their global central bank peers are getting friskier in the accommodation side, just when the Fed is trying to put
we are going to do. I'm convinced we absolutely have to do a separate show on Japan. I mean, you just reminded me of their conflicting contractionary fiscal policy and accommodative monetary policy, and then wondering why they sit in the doldrums. It's like that could be a reason as they increase consumption taxes at the same time they try to be accommodative. I'm really looking forward to next Friday. We're going to have non-farm payrolls. We're going to be in the wake of multiple Fed decisions. It's going to be an exciting show next Friday. Come back and join us
Christmas
on the Macrocast. What's that?
Like Christmas morning.
At Christmas morning, absolutely. Like our stockings will be full. Join us next Friday on the Macrocast.
Thank you for listening to the HPS Markets Policy Podcast, produced by Hamilton Place Strategies in association with Markets Policy Partners. For more from Hamilton Place Strategies, follow us on Twitter at HPS Insight. For more from Markets Policy Partners, please visit marketspolicy.com.